Curious about Warren Buffett's best dividend investing strategy for the coming year? Welcome to this quick overview. Warren Buffett, an investment guru, has a timeless, effective strategy. Known as the Oracle of Omaha, he prioritizes companies with three key traits. He looks for companies with strong dividends, solid fundamentals, and the potential for long-term growth. Buffett's approach to dividends is straightforward. He champions the reinvestment of dividends for long-term wealth creation. Simply put, compounding is where earnings from an asset, whether capital gains or interest, get reinvested. This reinvestment then generates further earnings, contributing to a growing wealth pile. This concept is fundamental to Buffett's investing. This is the cornerstone of Buffett's investment philosophy. The Berkshire Hathaway CEO also focuses on companies with a competitive advantage, or moat. This refers to a unique trait that allows a business to outperform its rivals. Essentially, it's a protective barrier that safeguards a company's profitability and market share. It is a distinguishing feature that competitors find hard to replicate or combat. This could be superior technology, strong branding, cost advantage, customer loyalty, or proprietary features. A wide moat implies a robust and sustainable competitive edge that's hard to breach. Look for companies with a wide moat, which means they have a sustainable competitive advantage. Buffett also scrutinizes the price-to-earnings ratio, often referred to as the PE ratio. This vital ratio provides an assessment of a company's current share price in relation to its per-share earnings. Essentially, it gives an insight into what the market is willing to pay for a company's earnings. This invaluable indicator offers a perspective on the relative value or cheapness of shares. Buffett has a clear strategy about a PE ratio that falls below the average, suggesting that the company's stocks are potentially undervalued. This indicates an opportunity for investment at a bargain price. Buffett typically looks for a PE ratio that is lower than average, indicating the company is undervalued. And let's not forget about Buffett's emphasis on management. This is truly a cornerstone of his investment philosophy. It's not simply about the financials or the product, it's about the people running the show. Buffett understands that the success or failure of a company can often rest on the shoulders of its leaders. Steadfast, competent, and ethical management is what he particularly seeks out. He's not interested in short-term gains brought about by reckless leadership, but rather sustainable success under the stewardship of diligent executives. This isn't just about profit, it's about integrity too. He looks for companies that are led by diligent and honest managers. Finally, Warren Buffett's investment strategy is primarily shaped by one key principle: patience. Known and admired worldwide for his unique buy-and-hold strategy, the billionaire CEO of Berkshire Hathaway doesn't let temporary market fluctuations affect his decisions. Unlike some investors who are constantly buying and selling, Buffett exercises remarkable restraint. He isn't one to hastily jump in and out of stocks based on the daily trends. Instead, he embodies the epitome of a long-term investor, maintaining his investment positions for an impressive span of time. This can be for several years or even extend to decades, proving his unwavering faith in his investments. In summary, Warren Buffett's dividend investing strategy for 2024 emphasizes strong dividends, a wide moat, and a low PE ratio. The strategy also values excellent management and the power of compounded wealth through reinvesting dividends. It's a long-term approach that demands patience and diligence. As manifested by Buffett's success, it can lead to significant financial gains.